My name is Mark. This is Patricio.
Hello, everyone. Great to meet y'all.
And I've been friends with Peter and Nancy at Sutton Capital Partners for years now. We've been doing some collaborations together, and I'm very honored that they invited me to bring one of my favorite clients to the stage to talk about KPIs. So I think we'll do this as just a real casual fireside chat, kind of back and forth, and we'll engage the audience. If you have questions, raise your hand as we're going. I want this to be a conversation, okay? And we'll all learn together. Great. So, Patricio, tell us just a brief couple of minute background on Abstract, both in terms of like your product and your target market, and also kind of the back end of the business and how that matters and how that's relevant.
Yeah, so the long story made short, we actually started Abstract as a senior thesis project out of Loyola Marymount University, which is quite literally a 10-minute walk away from here. Mo and I were studying electrical engineering, computer science. Matt, I've known way too long. I've known since I was 5 years old. And really, we were frustrated with the lack of transparency in government. And we were studying natural language processing models, which is, sort of fancy way of saying the early versions of AI used to break down text-based documents. And we said, hey, what if we use AI to abstract or make sense of government? Because no one knows what's going on, and government literally impacts everyone's lives, and it impacts every business. So that was where the idea came through in college. And for reference, my family's from Argentina. They ran for office over there, so that's where my political sort of background comes from. Mo's uncle, I found out later, was Prime Minister of Kuwait. And Matt's mom, I had no idea, was working at the Department of Commerce in Taiwan. So I found out about that afterwards when people asked us, like, oh, like, why should you be doing this? But anyways, we're really passionate about the space. And fast forward to now, we've raised about $2.6 million in venture capital funding. We have a team of 12 people, 14 people, and we have about 200 customers and raising our seed round now. So it's been one heck of a roller coaster. I still learn every day, about new things that just pop up, and been really fortunate to work with Mark and his team because I didn't know what I was doing. When it came to financial modeling and bookkeeping, I could do the basics, but that's not my job as a CEO. And now I've learned a lot more, and we'll talk about all these sexy KPIs very soon.
Thanks, Pat. And speaking of team, we have the Supercharger team here. There's 80 of us in total, about 5 or 6 here today in the room. Lisa Moyes, Kip, Hinky. We're wearing uniform. Robin's in the back. So come see our booth right behind the reception, on the other side of the reception desk later. We'll talk more about that if you need some help with your numbers. And this is a team effort. I dabble in this work, but I'm going to be kind of taking credit for the work of my team as we dig in together, to be clear. So you raised $2.6 million so far to date. You're out raising more money right now, but let's talk about the first round. What were investors interested in for those first couple of tranches?
On the pre-seed stage, really there's sort of 3 things that traditionally venture capitalists are looking at. And that's, one, can the founders hire? And doesn't necessarily mean can they hire, with cash, but can they convince people, about a mission and be crazy enough to join them to build something, right? So can they hire? Can they build, right? Can they actually code, right? We built the first product ourselves in the dorm rooms, literally. Can they build or do some sort of aspect themselves? And lastly, can they ship / sell? And does that mean, it could mean generating revenue, that's the best form of shipping and selling, but it can also mean just having a lot of usage on your product. So in those early stages, we amassed a small little team of 5 people, all in equity because we didn't have any money. We built the first product and focused our efforts to sell to lobbying firms and chambers of commerce. And we had about 30 users using it for free, but they were using it. It was a sticky product. And so once we hit those three sort of, it's a holy trinity of pre-seed investment, that's when the money started coming in. But I got rejected about 80 times. I pitched to 80 investors. They all rejected me. And I kept them updated once a month during the pandemic. And 4 or 5 months afterwards, I got 2 offers from Amplify LA and Mucker Labs. And we ended up going with Amplify. So that's how it started.
Great. So traction, early signs of traction. And let's pause here for a minute. Investors, their business model is to invest other people's money and get outsized returns, right? I'm talking about venture investing specifically. So their business model is to be greedy and risk averse at the same time. So greedy makes sense. They got to get a return to pay back their investors who are wanting to beat the stock market with their risky investments, right? And de-risk as much as they can by qualifying that the team has their shit together, that you can ship product. I don't think they're really tracking your velocity in like development quantities.
Yeah, mostly not.
Yeah. But that you can be good stewards of capital. So they were looking at how much you were spending in the early days, which was close to zero until you started getting off the ground, right? So I think in the early stage when you're raising money from friends, family, and fools, a KPI that matters is how lean you can be, how frugal you can be, how far you can stretch your dollar.
Yeah, and I would also say those are the most sort of stringent guidelines or baseline metrics we had to meet because we were literally college students, right? We were still an undergrad. If you are a second, third time founder, you've already exited multiple companies, you don't have to have much of anything to raise capital, right? Because now you have a track record to go off of. Similar to if you've worked in industry, it's a little bit easier to raise. But when you have no industry experience in the industry you're working on until afterwards you find out your family's related in politics, but didn't really help really. When you have no industry experience and you're fresh out of college, you really have to prove that you can, hire, build, and sell.
Okay. So you got a couple $1 million of early money, started growing your team, doubling down on building product, turned on monetization, right? And then you went out earlier this year in March timeframe to raise another round. And tell us how that went.
Oh, so it's been tough. The markets are obviously not the same as they once were. And we went out to raise our seed round in March of this year. And I was explaining to Mark, you can kind of think about it in terms of cohorts. So the first cohort of investors is almost like it was my test base, right? Testing out the new pitch deck, testing out, okay, we have about 150,000 of annual recurring revenue, but really, the retention, that's what's important. We have 5 hours plus use a day on our product. And they all passed, right? And I was learning, okay, as they pass, why are they passing? What's the issue? Oh, concern with the market, etc. So we tweaked the pitch deck, and then we had our second cohort of investors we were pitching to. And they, I got to the end of 3 of those with due diligence.
Wait, hold on. You're going too fast. So this is good.
Okay.
So
okay.
The first cohort of investors, you were talking about engagement, like how much time people are dwelling on your platform, and it's changing the way they behave, right? You're talking about revenue in terms of how much they were paying and user counts probably, right? So those were important for you. And what was the response with regard to your MVP beachhead product?
So, and I'm being very careful to say that these are general guidelines in terms of where the market's at, and we're talking about SaaS, right? It's very different for a consumer product. But for at least for B2B SaaS, what they were looking for was historically at least, $250K of ARR, $100K of ARR, just like somewhere in the 6 figures of annual recurring revenue. And if you had a ton of retention and stickiness on your product, revenue doesn't matter as much because it shows you have a sticky product. You just need some more time to grow. That was what used to be the standard. The new standard is about $500,000 of annual recurring revenue, And retention doesn't matter as much. We actually want to look for capital efficiency. We want to see if you have a product that can actually be profitable sooner than later. And so this is the first time these sort of expectations have changed in 20 years, right? Since the dot-com boom. The venture capital sort of market has been constantly inflating. Since the dot-com boom, the 2008 recession didn't really have an effect on this market. And all of a sudden we were faced with the fact that these people are looking for a lot more revenue, and all the sweat and tears we put into making our product really sticky and focusing on retention was being overlooked because we were barely at 150, 160,000 of annual recurring revenue. So we actually had to pause our fundraise and go back heads down to keep on iterating on product and really actually get our revenue up, which we'll talk about in part 2.
Right. Okay. So this is a good kind of reflection point. Understanding what the expectations are of investors 3, 6, 12 months into the future plus allows you to kind of put a game plan together, set some targets so that you can hit those metrics. And then when you show up to investors, you're telling exactly the story they're looking for. But you didn't have that hindsight earlier this year. Now that you have it, what have you done differently?
So what I know is actually I'm 24 months, 2 years ahead now. So I know, historically for Series A, most of these investors are looking originally for $1 million of annual recurring revenue and some sort of product market fit. So now they inject about, historically 5 to 10 million in your company, and then that's going to be used to what they call used for the go-to-market sort of growth and get you to 10 million of annual recurring revenue for your Series B. Now for Series A, the standard has moved to 1.5 and ideally 2 million. How do I know that? Because I've pitched to 200 venture capital funds since March, and I can tell you that on average, everyone's now looking for about 2 million of annual recurring revenue for the Series A. So working backwards, I'm like, okay, so in 24 months, we need to be at 2 million in revenue. With our current business model, excuse my French, there's no fucking way we're ever going to hit that revenue sort of goal in 24 months unless we totally change how we even think about our product, our pricing, etc.
And it's not because the market is too small necessarily, it's that the pricing is too small or both in combination?
I think there's both to be considered, right? Because you can have, a huge market with depending on how your pricing is set, right? If there's a high volume of customers you can sell to with low pricing, you can hit that revenue number, or you can have a bigger price tag and less customers and hit that revenue. It all depends on your market, and the amount of revenue you make is simply dumbed down, just revenue that you make per customer times how many customers, right, there are in the market. So we had to go back to the drawing table and say, okay, like, is this going to be even a feasible business? But I say, startups are not required to be audited. But when you go out to raise, it's almost like being audited. And so that first sort of 3 months this year was a sort of slap in the face that, okay, this is what's going on in the markets. We need to double down on making a more robust business.
Sure. And then you had to forecast out into the future how the business was going to achieve those milestones, $2 million in revenue, certain amount of engagement, retention, and stepping it up a level from your kind of beachhead customer to an entirely different customer at a higher price point. So to forecast into the future, we had to look backwards a little bit at your data as well. Had you been tracking the data that you needed to inform what was going to come ahead?
Yeah, and for context, we have 2 products now. So that initial product we call Abstract California, and Abstract California is sold to lobbyists and trade associations. And we were first looking at how much money are we making per account. So we had to look back and say, okay, on average, we're making about $2,000 to $5,000 per account. But we saw that there's an opportunity to introduce a new feature set, right, and sell closer to 10K, 15K an account. And that's still the plan for next year. But we started looking at retention metrics. We started looking at, churn, right? Who is leaving the product and why are they not using it anymore and why? So that was really important to sort of figure out, are we going to continue, developing this product, and is it even going to make financial sense? And at the same time, we started thinking, okay, we always knew we had to do enterprise. If we're going to, generate more revenue, we need to start kicking those sort of BD, business development gears into high gear, and figure out how we're gonna get a six-figure contract out of enterprise. And that's the
go-to-market strategy for the MVP product. It's like self-service. You make a bunch of calls, but people can more or less sign up on their own. The enterprise is more of like a BD focus, like a lot of like human labor power, right? So CAC isn't necessarily a cost that was very relevant to you in the early stages. And going into the forecast in the future, have you thought about how CAC plays into your plan?
Yeah, so CAC, customer acquisition cost. Again, because VCs and everyone in the market is asking you to be profitable sooner, what does it mean to be profitable? Simply put, the money that you're spending to acquire new customers and revenue should be less than the money that's coming in, right, from the customers, right? So before all this, we were very much just focused on, let's get a sticky product, let's burn as much money as possible to get these people, right? But that's not sustainable. So you have to start looking at CAC, which is a core metric, customer acquisition cost. And the customer acquisition cost is a mixture of your the sales and marketing required to acquire each additional customer. And so when your product is priced between $2,000 and $5,000 a year, there is not much you can be spending on sales and marketing for that to be a profitable sort of business. And so we had to think about, how can we make this either we're going to make it more expensive. That's not going to happen. The lobbyists are going to be like, screw you, we're not going to pay for this. Or we make it cheaper to grow, right? We reduce the sales and marketing costs per account. So really the first sort of step there was, let's make this self-serve. So instead of having our sales guy do all the work and myself do all the work to get these people on board, let's do these free trials so that they can onboard themselves. So that per customer, we're spending maximum 2 hours of our sales time, and everything else is automated. Now the customer acquisition cost number starts making more sense. And we actually did the calculation. We're at 85 customers, 200 users. Once we hit 150 customers, which we should hit by February, that business unit's going to be profitable.
All right.
So, yeah.
I'm shooting for that one. I'm
yeah.
right there with you.
Oh, yeah.
Okay. And so if you're spending a couple hours or like, a few $100s per, like what is your CAC right now on that product? What are we forecasting? Kip, do you have it in mind?
That number I don't have in mind, but
okay.
It's pretty high. It's going down over time, so we're seeing economies of scale over the development of the product.
Okay, so thanks. So I guess let's say it's let's just say it's $200 against a $2,000 subscription. That means that we're going to earn back the revenue to pay back the acquisition costs in 1/10 of like a license period. But if the acquisition costs are, let's say, $500 per account, then you're going to be halfway through the you're going to be a quarter way through the 10. It'll take you 25% of the revenue to pay back that CAC cost, and so that slows down your growth opportunity. So if you're trying to manage burn to get to profitability, you have to temper your spend on acquisition so you don't spend all your money before you start earning that money back. Now, with the Beachhead product, you're charging like monthly licenses. With the enterprise product, you're charging an annual upfront, right?
Mm-hmm.
And so that's going to help advance. You're basically borrowing money from your customers to fuel the next round of marketing spend to acquire the next batch of customers.
Mm-hmm. And it takes more time, but it's worth it because they're larger contracts as well.
Okay. And so lifetime value. It's something that a lot of investors ask about. I'm sure you've been asked about lifetime value a ton. But how long has your product been in market?
Year and a half.
Okay, so like, do you have any sense around lifetime value right now for that beachhead?
Roughly, but you can't. It's impossible.
So we can see like how many of those early customers have renewed, and then extrapolate from there to like guesstimate how long they're going to continue paying and how much money you're going to get in total. But it's way too early. So I'll say that investors are going to ask about that because they want to de-risk their investment. They want to be able to see into the future and anticipate how like how likely is it that the business is going to achieve cash flow positive profitability. And you do that by extrapolating from the LTV and understanding what your acquisition costs are, and then it's kind of like a flywheel that keeps spinning faster.
Yeah, and I would say the reason why LTV takes time, so lifetime value, what goes into that is customer acquisition cost, but you also have to know the lifetime value. You have to know how long a customer is with you. And that's why it's really hard to calculate lifetime value early on, because you don't know what your churn is like. Like, you don't know on average, does somebody stick with your product for a month, for a year, or more. And so that's why as your company matures, you start getting more sort of metrics around when people may leave, and that's where you can get a more accurate lifetime value metric. But that's more important at the Series A stage. So when I was telling you guys about, okay, we should be hitting 1.5 to 2 million in revenue a year, by the point we're hitting 2 million of revenue a year, we should have enough data to calculate lifetime value, and that's a core metric that Series A investors are going to look at, not necessarily at the seed stage.
Right. And so this right here is just kind of a simple representation visually in terms of number of subscriptions over time. And this is not abstracts data. This is made up numbers here for demonstration purposes. And we can make this available to anyone who wants a full copy of the deck. There's not a whole lot in here. But this is growth in total number of users. You can also measure revenue this way. And then this right here breaks it down into individual cohorts. Has everyone seen graphs like this before? I don't want to go too slowly. Is this good? Okay. So this represents customers who signed up in January of 2022. The red is February. These are customers who signed up in March, in April. And you can see these triangles get skinnier. That's because not every customer sticks around forever, right? Some churn out. And so when you break out the customer counts into cohorts like this, you get a lot more visibility into what's going on. And
real quick, I was going to say this is also important because when you're running, especially like a SaaS startup, sort of SaaS sort of business, you may have pushed an update to your product in April, and suddenly because of that update to your product, now you're seeing more retention with your cohort. So that's why it's really good and useful to see this in terms of cohorts, so you can see if the sort of progress that you're doing on the product side is translating to better retention.
That's a pretty scary trend you're showing.
not necessarily, but
no, that's actually good. Yeah, well, I can talk about retention.
Well,
I mean, your customers aren't sticking around that long.
sure. Now, it's very unlikely that any SaaS business is going to have 100% retention in terms of like logo count or user count, customer count, because nothing lasts forever. But especially when you get into enterprise, then there's the opportunity to expand the revenue with each account that you have, adding more users, adding more features that have higher license fees. And so even if you're losing some percentage of your customer accounts, if the accounts that are sticking with you are scaling and growing, then even while you may be dropping customers, your revenue is still climbing. And so we have some examples of that here a little bit. But we'll just stick on this one for another second, and I want to go back to Pat. Here's another case that becomes visible. This is a similar chart as the ones before, but instead of just kind of a dinosaur back, we've smoothed out the curve. But what we're seeing here is these are the customers that were added in January, and then this is the amount of additions in February, and this is the amount of additions in March. You can see this is a nice steep growth curve. What happens right here? We're still adding customers every month, but we're not growing in total customer count. Or again, this could also be representing revenue dollars. We're not growing in total revenue dollars. Why? Because these customers right here who started, some of them are churning out. And so the drop, the altitude that dropped right here was made up for right there But then in this month, there wasn't enough sales to make up for that drop that happened right there. And so we're starting to flatline. And I'll show you the numbers behind this chart later. So when you do your cohort analysis on a user account basis, an account basis like enterprise accounts, and on a revenue basis, you start to tease out a lot more insights that are actionable. Like you said, Pat, when you can see, oh, a new product release caused better retention than was there before, you need to look at the cohort data.
Yeah, and also like CEO product hat on, what this signifies is a leaky bucket problem. So if you think about a leaky bucket, you pour water into it, but the water is going to come out the bottom, right? So you can't retain the water inside the bucket. So usually when you see a flatline or a decrease, that means your bucket is leaky on the bottom. That means your customers that you onboarded early on are churning or leaving. And so you're spending more money on sales and marketing to acquire new customers, i.e. put more water into the bucket, but the bucket is leaky, so it's staying, the water level staying the same or dropping because there's holes. Once you fix your product issues, right, and it's not as leaky anymore and people aren't churning, now you can actually fill the bucket up with more water. So I always think about that leaky bucket analogy when I look at cohort charts.
And going back to a few minutes ago with customer lifetime value, the total cumulative amount of revenue or profit that you'll earn from each customer over time, you need to think about that in context with your customer acquisition costs. And what I see happen often, which is a big pitfall of kind of a rookie mistake as a founder, like spending too much to acquire a customer, sure, that's easy to understand if you're never going to earn the money back. But what about offering promotional discounts for customers to come in the door? Basically, you're saying, you don't really accept my list price, but if I give you a 30% discount, will you try it for 3 months? And everyone's like, sure, that sounds like a great deal. So you're getting less revenue than you normally would for the first 3 months. And if those customers weren't ever the right customer to begin with, once the price goes back up at the end of the 3 months, are they going to stick around or are they going to churn out? They're going to churn out, and you're not going to earn your lifetime value that you were hoping for to pay back those user acquisition costs. So
I think, Eddie, you're here. So Eddie's our head of sales. So Eddie, somebody asked for a discount today. What do we tell them?
No.
Exactly.
Okay, so here is a chart showing, these are all from the exact same data set. So this data set right here, here's some numbers behind it. The red verticals represent churn in terms of number of users here on this side. And then this blue line here represents churn as a percentage of the total number of users. And as you're, you can see they kind of follow each other pretty closely, which makes sense. But how can you use this kind of roller coaster to forecast what your churn is going to be in the future? It's kind of hard. You can't really, you can average it out and be like, it looks like about 6%. But I don't think that's appropriate because people are churning out at different times in their customer life cycle journey.
Yep.
So that's really important. Another good reason to look at the cohort trends. There's a lot of numbers here. I don't know if you can see them in the back of the room.
This took me like 2 weeks to figure out and to understand.
So this is referred to as a cohort waterfall. And here we have customers who signed up in a certain period of time, let's say January. I think these dates are wrong, but it's January, February, March, April, all the way down. And this shows what percentage of those customers who signed up in January canceled in February, churned out, another cancellation. And here is a very simplistic representation to show after the 3-month trial period, we lose a third of our customers because they weren't really in it for the long run anyway. They were just kicking the tires. But then the rest of the customers who stick around, only a few of them churn out, hypothetically, and then they come up to an annual renewal point, hypothetically. And this could be another place where you lose a lot of customers because they're like, I don't want to pay for this for another year. I'm done. And so modeling things out this way enables you to forecast your revenue and cash flows a lot more precisely. Do you have anything else to add on this?
No, just that for consumer products, it's way more intense.
That's right. Okay. We can come back to this in a minute. Do you want to talk more about your current round of capital raise and what KPIs are more interesting, or what what are the most important metrics that we're thinking about in the forecast?
Yeah, so now thinking about where the market is at and quite literally the KPIs that matter. Uh, revenue, month over month, the growth of revenue, best in class is 35%. So if you can demonstrate that your revenue is growing 35% month over month, 35% more revenue each month, you're in A1 standing. I mean, if you're past 20%, that's great too. So I would say, at least at the seed stage, most investors are looking for consistent revenue growth month over month. And beyond consistent revenue growth, they're looking at the customer acquisition cost as well, because they don't want to see you burning most of your money to acquire that new revenue. And beyond that, being reasonable with how much you're spending on your payroll and your people. Most seed stage companies are between 80 to 150,000 of gross burn. So we're burning about 100,000 a month, $100,000 in payroll and hosting fees and all that. So they want to see that, you know, the founders aren't being stupid in how they spend money, and that the team is working, you know, like a well-oiled machine to grow revenue each month. So I would say those are the core metrics at the seed stage.
Cool. So here we're calculating month over month growth, and in the early stages, this business is beating that 30% benchmark.
Yeah, actually, this is a perfect example.
But then right here, we drop down and we're only growing 10%, 8%, 11% a month. And the reason why is probably because they dialed back on marketing spend. And so they're not acquiring as many customers. And that's where we saw that growth curve flatten out. And they were flat for a while. And so this is a problem. But if you're also trying to conserve cash and extend your runway, then you know, you've got a chicken and an egg problem, because you don't have enough money to grow and hit those growth metrics, but you need to preserve cash. So then we get into operating leverage. Yeah.
How do you calculate that percent month over month, or just additional bookings?
Yeah, it's like, you know, I have $100,000, or I made $100. Well, actually, yeah, you want to, yeah.
Come by our booth. We'll talk about it after in detail. I don't want to take, like, are there other questions? I want to keep the conversation flowing. But the short answer is yes. You divide your current month revenue by your prior month revenue, and you get like a percentage increase. And you can do that same kind of thing. Now there's the concept of gross and net. And when we're talking about like an income statement for a business, gross usually is a bigger number, and net is a smaller number, because we're netting out some like expenses or refunds or discounts. When you're talking about retention and churn, it's actually inverse. The gross number is smaller and the net is larger. So right here is this isn't the exact same. Well, yeah, this is. So if we're talking about like net dollar retention, you're going to be including the expansions and new bookings in there. If we're talking about, so if you upsell your customers and they pay an additional $7,000 more than you got before, and you sell to $5,000 worth of like new customers, you get to roll that in on top of the base revenue. But then you subtract out the customers that you've lost. But on a net level, you don't get to count that upside. You're just saying, how much have I lost net?
Yeah, and like, again, like CEO founder hat on, the important thing to keep in mind here is that you're not limited by just the new sort of accounts and organizations you acquire. A lot of revenue comes after the fact that you acquire that customer, and now you're either selling a new version of your product to that same customer, or you're selling more seats, right? So that's called upselling. There's also cross-selling, where you're selling to other departments in that organization. So those are things that we overlooked initially, and now we're doubling down on how can we increase revenue with our current customer set, not just looking at new customers only.
Right. So hindsight is 20/20. When you learn these things, you say, shoot, I wish I was tracking that data yesterday, last month, last year. So take the lessons from other people's mistakes here, and it's never too early to start capturing the data that matters. Because even if you don't know what to do with it today, it will be very valuable data to build some empirical base cases for your extrapolations for your forecasts. So operating leverage, you were just saying like you need to keep your operating expenses low, your burn low, and like for Series A and Series B plus capital raise, operating leverage is one of the really important key metrics because it shows for each new dollar of revenue that you're adding next year versus this year, how much less additions do you have to add to your operating expenses? And that's how the business keeps scaling up faster and faster without needing more cash to pay for it because you're making more money than you're spending. Every year it's growing. So operating leverage is a really big KPI for growth stage companies.
Yeah, this happens usually once you've hit product market fit and you're in the go-to-market fit stage. You have a clear market that you're dominating, and now it's like, how can I be more capital efficient as I grow and maybe leverage venture capital money or maybe debt, and yeah, that's where operating leverage comes.
So we don't have anyone else coming in this room. We can stick around and have more Q&A riff. Our booth is literally right across from the reception desk. If you want some help with your numbers, with your data, we're offering promos to people who are here today and who engage with us quickly. So check it out there. And thank you for coming.
And I'll be walking around as well.
The QR code is right here as well if you want. It'll just take you right to this website. But please raise your hand, shout out if you have more questions. I'm happy to stick around. You here, and then you'll be next. Yes?
What's the calculation for operating leverage?
The calculation of operating leverage is the year-over-year change in revenue divided by the year-over-year change in OPEX growth. And so an operating leverage metric of 1 is like perfect. You can't really do any better than that. But as you get down closer to lower numbers, then you're not performing very efficiently. Yeah.
Yeah, and that's OPEX, not COGS. So operating expenditures, which does not include your cost of goods sold, because cost of goods sold is tied to literally the cost to sell your product. And that's usually for SaaS. Cost of goods sold is customer success related payroll, and hosting fees is typically your COGS in SaaS.
When you were talking about the customer acquisition costs and what the investors want to see, and that going down obviously over time, are they also tracking like the costs of the customers you're with? Like,
Yeah, you're tracking your entire spend on sales and marketing for your customer acquisition costs. If you're going to trade shows and that's part of your customer acquisition strategy, those costs count.
so you're putting it all in, and then by the customers you actually gain.
Yeah, but we were pretty like lean and mean with customer acquisition cost in the early days. The way we looked at it is, okay, if we're going to go to this conference, we're going to spend all this time and money, we should at least be generating 3 times the amount in revenue. So if I spend $5,000 in flights and hotel and blah, 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 blah for this conference, I should be making at least $15,000 in revenue from this conference. Yeah, but now ever since we started getting more granular with our bookkeeping and our historicals with Supercharger, we have more time as well. We have about a year's worth of data where we can look at historically how much we've been spending on sales and marketing and how that's translated to new revenue. So
yeah, and I say you can segment your sales and marketing costs into different buckets. If like one sales and marketing spend activity is specifically focused on delivering a certain subset of results, you can measure your CAC for that activity separate from. So for example, like the MVP product that Abstract is selling right now versus the enterprise product. We may want to split the sales and marketing costs between the two. Right. If you mush it all together in one big mush pot, then you lose the visibility to understand like where you're getting the best return on your sales and marketing spend.
yes, you want to make sure it's tied to the product. Yeah.
Hi.
For early, when you're still figuring out product market fit, and you see like the salespeople selling stuff that's not in the product yet or whatnot, how do you kind of figure out the signal in those sales and those metrics, and how does that influence the product market fit?
Like how early?
Really early when you're like still going to market before you were still figuring out the product market fit.
So your question is, what are the signals? What are some signals you can look at that like signify you have early signs of product market fit?
Well, I'm also wondering, like, did you have to go through a period where you had to do some level of customization for early clients as you're building the product, and how did you kind of look at that revenue, which was not really SaaS recurring revenue?
I can. Okay, so there's a couple of schools of thought here, and I'm gonna not talk about consumer here. I'm just gonna focus more on B2B SaaS. One of the schools of thought is in the early days, just build product and get as many people to give you feedback on that product and just put it in their hands and at one point charge for it. And that's what we did initially. But now, like my updated school of thought is no, you scope everything out for that customer and you literally tell them how much it's going to cost, and it's not until they pay for that you give them product. But that's again for larger ticket sizes and for enterprise. So yeah, Kip.
We're gonna turn off the mics, but we'll keep the conversation going right here. They need the mics for the other room.
I like the mic.
Yeah.